So, in the 12 months ending in September 2022, the US had an inflation rate of about 8.2%, down from a high of like 9.1% in the 12 months leading to June. These are inflation rates that we have not seen in the United States since like the 1980s, right?
Yep.
Consumer goods are very, very fucking expensive right now. At the same time, retail goods companies are seeing record total profits. Lowe's recorded $8.4 billion in profit in the most recent quarter, specifically citing new pricing strategies. TJX, the parent company of TJ Maxx, Marshalls, and Home Goods, saw last year's profits soar to $3.3 billion. The CEO specifically cites aggressive pricing strategies. And Target boosted its profits to $6.9 billion in 2021. And similarly, the CEO called out a year of record growth. So when we talk about inflation, at least so as we've talked about it so far, the research that we've been reading has largely pointed to supply chain issues paired with enough money from, consumers for them to actually continue to purchase stuff. So restricted supply is being the primary driver of growing inflation.
Yeah.
But one thing we were really curious about is the role of the middle people, right? Corporations delivering goods to consumers and their profit margins in the role of driving inflation, right? Because if it's all supply chain, then it's all the value chain that leads into those corporations, right?
Yeah.
And then once it's in there, if they were to pass that cost along to the consumer, that would be supply chain driven inflation. But so the question we had was, what's the role of the corporations that are actually selling these goods in driving inflation?
And this has become a talking point among a lot of leftist circles, and it's been starting to be talked about more within the actual elected Democratic Party as a major contributor to inflation and potentially an explanation.
Yeah.
So I spent a lot of time reading about this, and what's interesting was I kept finding articles that were supposedly debunking that claim. All right. I would find an article that would say, the left claims this, or Democrats are claiming that it's greedflation, but economists are all saying that that's not true. And I'm like, okay, economists. Okay. What are the numbers? And it's like, yep, they say it's not true. Okay. And I'm like, oh, I said, okay, article, but can you tell me what the numbers are? They're like, economists say that it's not quite true. I'm like, okay, but can you, but what are the numbers here? What are the numbers here? And they're like, economists say that the primary drivers are supply chain and government money from the stimulus checks. That's what economists are saying. I'm like, okay, but give me some fucking numbers. And they weren't giving me any numbers. And I was very disappointed because I love numbers. And so I started looking more into it. And I finally found some numbers. And it turns out that the economists are kind of wrong.
Well, at least the ones that these articles apparently seem to be talking to.
Yeah. So here, I want to make one thing absolutely clear. All right. The thing that sparked current inflation was supply chain issues. And we've said that 100 times on this pod. All right.
Which is driven by the pandemic. If you remember, we broke this down pretty early on. I think very early on in the pandemic, we were like, guys, just so you know, temporary slowdowns in production as a result of anticipating a recession and scaling back, or as a result of workers getting sick, can have huge downstream impacts. One of the first bubbles we saw was in the lumber market when they shut down lumber production, and then it turns out everybody wanted to build their homes, and lumber demand shot up, but it took weeks and weeks for supply to get up there. We talked about the basic math behind the idea that if you're shut down because of pandemic related things for 1 week, but your demand doesn't diminish, right? Without significant excess capacity just in the system, it can take years to catch up from that 1 week of being shut down. Supply chain issues were driven directly by the pandemic, and they're directly what's driving inflation.
Yeah, bottlenecks at ports of entry, like in California, where you had all these boats with a ton of goods that were just sitting there in the harbor, and there weren't enough trucks to transport those goods around the United States.
Yeah.
That reduces supply, which increases demand, and you end up having a situation in which, in order to make up for it, you have to raise the price of everything. So obviously that was the start of it. All right. Yeah. Now, you can make an argument about there being a slight impact from the stimulus checks, but those stimulus checks also allowed people to live.
Yeah, and importantly, what we found was so the argument from the stimulus checks perspective would be true if you injected just tons of money into the economy, and like basically what you did was you took all the money that was already floating around, and then you put a bunch more in there. But what actually happened was unemployment reached record levels. People, like 13% of the working population didn't have an income. So like income supplements and stimulus were the things that kept people afloat. And so when their balance sheets dried up, those sources of stimulus enabled them to stay afloat. So what that did was replace their income. Now, in some cases, in low-income people, it would replace greater than the value of their income. But those are, like, relatively speaking, smaller cases. And ultimately, like, the impact of that stimulus was only an exacerbator of inflation because of the diminished supply available.
Yeah. And even one of the articles that I read, this was a Fortune article that I read that was trying to debunk the idea of corporate price gouging being the primary driver. Even they pointed out in their own numbers that there was research from the Federal Reserve Bank of San Francisco that said that the economic relief from the government increased inflation by 3%. Versus bottlenecking, supply chain issues contributed to 20 points of increase. So
no,
3%,
it was all Biden and his
20%.
stimulus checks.
So like even this article that's trying to focus on those specific things as the drivers and not corporate price gouging, even this article admits it's much more to do with that supply chain. Mm-hmm. But that brings us to what extent could corporate price gouging actually play in this? Mm-hmm. Because as Michael pointed out, a lot of these companies are experiencing record-breaking profits at the same time that the rest of the United States is suffering from the cause of inflation. They're suffering from the fact that the gas prices are too high. They're suffering from the fact that food is too expensive. So the Economic Policy Institute broke down an analysis of this, which I think paints a really interesting picture. All right. So there's some things that we need to understand before we go over these numbers. First off, these numbers are about the increase in overall prices, which in the second quarter of 2020 increased at a rate of 6.1%, which, to put that into perspective, price growth between the pre-pandemic business cycle of 2007 through to 2019 on average had a 1.8% annual growth. Now that's 1.8% before the pandemic and 6.1% after the pandemic. So keep those numbers in mind. And these specific numbers are focused on the non-financial corporate sector. Mm-hmm. So companies that provide goods and services to the economy, which makes up roughly 75% of the private sector. So the Economic Policy Institute took a look at that annual increase of 6.1%, and they broke down where did that money go into. So when it comes to producing goods and often services as well, there are three things that you want to consider when you're looking at an increase in prices. All right. The first thing is, of course, corporate profits. All right. To what extent does the price increase go into corporate profits? The second is non-labor input costs. And that basically means your supplies. All right. So think about, in this specific case, the biggest thing that's going to that's going to impact that is going to be the supply chain.
Mm-hmm.
And finally, unit labor costs, which means labor, the cost of labor, the people that you're paying.
Per thing that you produce. So that
per thing that you produce.
You can scale, yeah.
Exactly. I want to take a look at the 1979 to the 2019 average versus the 2000 to 2021 average. So like pre-pandemic average versus post-pandemic average, or during pandemic average. All right. So in terms of unit labor costs, the price increase, the annual price increase, 61.8% of the price increase, the money from the price increase, went into unit labor costs versus during the pandemic, 7.9%. 7.9% versus 61.8%. What that means is that a significantly less money from the price increase during the pandemic went into labor than it did prior to the pandemic. Mm-hmm. All right. So let's look at non-labor input cost. Before the pandemic, 26.8%. During the pandemic, 38.3%. So we do see an increase there. All right. Yeah. We do see that there is like over a 10% increase in the percentage of the price increase going towards non-labor input costs versus prior to the pandemic. And that makes sense because that accounts for the supply chain.
Yeah. Now note that if a company was just passing along their supply cost to consumers, all of that increase would be non-labor supply costs, right?
Yeah.
Like if it was just the supply chain driving the cost and they were directly passing that along, that's where it would all go.
Yeah. Yeah. Now let's look at corporate profits. Prior to the pandemic, 11.4% of the price increase went into corporate profits. During the pandemic, 53.9%.
Yeah.
53.9%. 11.4% before the pandemic. During the pandemic, 53.9%.
Yeah.
These numbers paint a really important picture. Now, again, I do want to be clear that the thing that started inflation was supply chain issues. It was not like one day a bunch of corporations got together and said, hey, we're just going to start jacking prices up. That's not what happened. However, a major driver of inflation, once inflation started, was corporate price gouging. And these numbers make that abundantly clear.
Yeah. This is a really, really strong analysis. And I think it's stronger than most of the ones that you're seeing out there. Because I was skeptical, I'll be honest.
Yeah.
Because I was thinking initially like, oh, everybody's citing corporate profit growth, right? But like profit growth can happen even while cost growth happens, right?
Yeah.
So like if you have higher costs, but your investors still require the same return on your revenue, right? So they expect basically the same profit margin. So for every dollar of revenue, how much money you make. If your costs double, then your price has to double, right? But then if you're like selling if a $1 costing, if a toothbrush that cost you $1 to make before now costs you $2, then you need to charge $4 for it, not $2, right? Or not $3. So like the actual amount of profit has to double, right? Because the cost doubled in order to keep your profit margin the same. But, if you think about it in terms of actual dollars, your cost only went up by $1. So you're actually making more dollars in profit, even if your profit margin remains the same, if your costs are going up. So like initially I was like, well, like maybe people are just keeping their profit margins the same, which is bad, right? Like the fact that you have costs going up and you're not just passing those along, but you're actually taking advantage of that fact in terms of to keep your profit margin the same so you don't look bad to investors. That's not great, but it's like kind of what our investors expect. It's what you expect from companies on the stock market, is to keep their profit margins consistent, which would lead to growing profit as cost increased. But the fact that those cost increases are primarily coming from profit, and the fact that we're seeing growth in profit margins means that, you know, when they take that $1 toothbrush and their costs go up to $2, right? It means that their price doesn't just go up to $4, it goes up to $5. So their profit margin goes up, right? So like that's when we start seeing it really become clear that this is a pretext. So Isabel Weber, a professor of economics at the University of Massachusetts, told ABC News, quote, "In the case of sector-wide supply chain issues, as during the pandemic, firms know that their competitors face the same bottlenecks as themselves. The public, too, is aware of the supply chain issues. Taken together, this presents a pretext to increase prices."
Yeah. Yeah.
Which is why CEO after CEO is citing, you know, significant profit growth and profit margin growth throughout this period. So an analysis by The Guardian of SEC filings found that for 100 U.S. corporations, so 100 of the largest U.S. corporations, they found that the median net profit increase went up by 49% last year relative, well, in like the most recent filings versus the quarter before.
Yeah.
49%.
This also flies in the face of the common claim that I've been seeing float around on the right about how one of the drivers of inflation is the fact that all these companies are raising wages in order to try to attract workers that don't want to come back to work because of the pandemic.
Yeah.
But again, I point to those numbers that I read earlier in terms of unit labor cost. You know, when we're looking at the percentage of the increase in price year to year, because, you know, inflation is a constant thing. Like there is gradual inflation year by year.
We want
and
that.
And we want that. All right. There is gradual inflation that happens year to year, but we want it to be controlled. All right. Right now, inflation is out of control, but, you know, inflation needs to be controlled. So you're going to have price increases every year, regardless. Prior to the pandemic, 61.8% of the price increases went to labor cost. And during the pandemic, only 7.9% of it went towards labor cost. 7.9. It's not about wages. All right. Mm-hmm. It is not about wages. It's just not. You're just wrong. You're just wrong if you think that. So then the final question then is, what are some solutions to this?
Yeah.
And there's actually two potential solutions.
Wait,
one
solutions? Isn't the marketplace self-correcting? Yeah, maybe if you want to take a fucking decade.
Yeah. And even then, you know, it's...
And then it's not, yeah.
And then it's probably not going to be after a decade.
Yeah.
But yeah, so the first solution, and this is the solution that I've been seeing the most attention given. This is a solution that Joe Biden actually recently came out in favor of, and that's a windfall tax, which is actually something that has been done in various other European countries. The United Kingdom did it.
Yeah, and sometimes you can do it on like a temporary basis if you're not ready to commit to, you know, a windfall tax forever.
Yeah, which would probably make sense in this case. It seems like that could be a decent solution. All right. Some of the counter arguments about that are, if you do that, they'll raise prices even more. But again, the more that they raise prices, the higher that percentage becomes, or at least the higher argument. Like the more money ends up getting taken.
Yeah, exactly.
So that doesn't really.
So a windfall tax basically is taxing profit above a certain amount, right? Or profit margin above a certain amount. Yeah, exactly.
So then the idea would be take that money and redistribute it. All right. So that way like that would disincentivize them from increasing the prices as much. So it would be very likely to lower prices actually.
Yep.
And it would also provide additional revenue to potentially help everybody else actually benefit from that, from that profit. I mean, you know, you always talk about a rising tide lifts all boats. Well, buy more
Lift
people
'em.
boats. You know, that only, I mean, as Jon Stewart said, that only works if everyone has a boat. So take that money from the rich and buy more people some boats. But that is a short-term solution.
Mm-hmm.
And I think that one of the things that a lot of people, a lot of Democrats, a lot of people on the left, I think are missing in this conversation is the root of the problem. And the root of the problem is the fact that we have decades of corporate mergers. We have decades of corporations consolidating with each other. We have decades of monopolies being developed over time. We have decades of decreased enforcement of antitrust laws, not updating antitrust laws. And because of this, we can't rely as much on competition to regulate the market as we used to be able to.
Yeah.
So if a huge company decides to raise prices on everything, if they control enough of the market, then everyone else just has to fall in line.
Yeah.
All right. So because there's so many of these markets have power concentrated in just a few companies, you end up having a system in which competition is not actually allowing the market to regulate itself, which means that you're left with you're left with just the corporate bottom line, which is to maximize profit and limit losses as much as possible.
Yeah.
So of course you're going to have a system like this.
Yeah, by any means necessary. You're having companies essentially, even if they're not functional monopolies, exercising monopoly power over the marketplace. So Lindsay Owens, executive director of Groundwork Collaborative, which is a liberal think tank, put it this way. What we're seeing in this moment is that companies with the biggest market share, with the most market power, the most pricing power, are the ones who are really engaging in the most egregious profiteering. Which makes sense. To Nathan's point, if you're Walmart, if you're Amazon, like you don't have 100 competitors all nipping at your heels. You have one, you have maybe two. You know, you have amazing market concentration in terms of your suppliers. They can't raise prices on you. You set the prices. You have so much power that you can essentially set your operating conditions. And so when you get a pretext like, oh man, there's really lots of inflation, prices are going to go up, especially when the consumer has actually enough money to continue buying stuff because they had things like, income replacement.
Yeah.
You seize that chance.
Yeah. Yes, a windfall tax I think makes sense. Let's do that. But that's a short-term solution, and it would probably be a temporary solution, as it probably should be, honestly. But if we really want to prevent this shit from happening in the future, we have to enforce existing anti-competitive practice laws and antitrust laws, and we need to expand on them.